Hello, everyone, and welcome to this Cinder webinar. Today, we are going to be talking about the top 5 failures in preparing for due diligence. We're really excited today to have special guest Helena Patience with us, and we will get started in just a few minutes. But for those of you joining us live, if you wouldn't mind in the chat letting us know where you're joining us from and any comments or questions that you might have, things you're excited to learn about today. We will have a time for Q&A at the very end of the webinar today, but of course, you can feel free to drop those questions in at any time. So let's see. Let me open up the chat here. Let's see. I'll go ahead and, oops, mine is not set to everyone. Let's see where I'm joining from. And for those of you who have just now entered the room, if you wouldn't mind going ahead and letting us know where it is that you're joining us from today. We always love to know where our audience is from. We have people that join us from all around the world, which is wonderful that we're able to do that on these virtual events. And we'll go ahead and get started here in just about 1 minute. That's great. We'll give it just 1 more minute here, and then we will get started. Again, if you have questions as the webinar is going, please feel free. You can drop them in the chat, or even better, if you could use the Q&A bubble down at the bottom of your Zoom window. That helps us organize the questions and see them a little bit easier. And we will have a time of Q&A at the end. So, but don't feel that you need to hold the questions until then. You can drop them in that Q&A chat at any time, and we will see them. So, okay, well, let's go ahead and kick things off. I'm really excited today to introduce our special guest, Helena Patience. Helena has over 15 years of global experience in finance and HR across many industries, including tech and manufacturing. After working as a financial analyst at Lululemon Athletica, she founded EntreFlow Consulting Group, which is a cloud accounting CPA public practice and licensed recruitment firm. With a team of 20, EntreFlow accelerates business growth through accounting, fractional CFO, HR, and software implementation services. The firm has supported hundreds of startups and scale-ups to crush their goals. Helena is a QuickBooks Elite Level Pro Advisor, sits on the Intuit Pro Advisor Accountants Council, a mentor for CPABC, Futurepreneur, and the Forum for Women Entrepreneurs. So welcome, Helena. Thank you so much for being here today.
Thank you so very much for having me. Delighted to be here and to hopefully share some good tips with our audience today.
Yeah, I'm excited. We've got a bunch of questions that I'm going to ask you as we go, but are there any opening remarks you'd like to share as we get started on the top 5 failures?
Sure. It's a bit of a downer buzz conversation today, but really, it's we work with a lot of companies that are going through acquisitions, support them through their acquisitions, either either side of the fence, either buying or selling. And so there's some common things that we see. So hopefully this will help people to prepare themselves for an acquisition, because it's always a lot more work than everybody expects it to be. And it always takes longer than everyone expects it to take. So hopefully this will help arm people with some knowledge to make it a little bit of a smoother process, because it can go smoothly. You just need to be prepared.
Awesome. Okay, great. Thanks. Well, let's dive in. So just to kind of kick things off, in case anybody here isn't aware, could you explain what is due diligence and why it's so critical for SaaS businesses?
For sure. So, a lot of people start businesses, and you have different kinds of exit plans. You might want to hold on to the company and pass it over to your family. You might wind it down at some point. But a lot of people start a business because they want to, at some point in time, sell it and cash in on their equity. In order to do that, you have to have a willing buyer. Okay. So the due diligence process is really the probably least fun part of the whole transaction, where the buyer and the seller are sitting down looking at documentation, understanding the business, what's going on with the business, and where could it potentially head, so that the buyer can have good confidence and trust in the seller and their business and what they're offering, and help to determine that price at the end of the day. So it's a period that can last. I've seen it be as short as a month, and I've seen it as long as 18 months. And this is working in before started Entreflow working in other software companies and other organizations through Entreflow with small to medium-sized businesses. So it can take quite a while, and it can be also very very short. It just depends on what's happening for both businesses. So that due diligence period is the kind of getting to know you, reviewing all the documents, making sure that everyone's super confident in what they're actually buying, and getting to that final number before the negotiation starts.
Okay, awesome. And can you provide an overview of kind of the typical due diligence steps that like a SaaS company would take?
Certainly. You might have a little bit of a pre-due diligence that might happen before we get a letter of intent or an LOI in place. And the LOI basically locks in, from a legal standpoint, a period of time where the seller can't pursue other people. And so before that LOI is signed, typically there's a little pre-due diligence that'll happen where the buyer will want to look at some key information just to make sure that we're not out to lunch here. The LOI might have some realm of numbers that the buyer's looking to play in so that we're not wasting everybody's time. And then once that's signed, then we jump into full due diligence. And so they're typically going to look at the financials quite heavily out of the gate. For a SaaS company, there'll be a lot of review of the code and some of the key people there, maybe the CTO and other key people, just to make sure that the quality of the code is there and that the app actually does what it's supposed to do. At some stage, they might want to have some conversations with existing customers, and again, make sure that what they say the app is doing it for the market. But so it'll start with usually with financials and work through operations and sales and other team HR and everything along the way. And once the buyer is confident, or we get to that period of time in the LOI, then it's got to stop and we move on to negotiations from there if it goes past that point.
Okay. And do you think do SaaS companies in general underestimate the complexity of due diligence?
Yes, I find that generally SaaS companies are very, very focused on development. It's a very complicated, time-intensive kind of focus area for them, and sales, right? So they tend to split their time between the development and the sales, and not a lot of time on data and metrics, especially financial data. And so what often happens is that people assume that the code is going to be the biggest focus and they're going to be talking with a bunch of developers. That's not normally the case. You're usually talking with, investors, VCs, people who are very competent with business, who understand code, but they're not developers. And so they're more interested in, how is the company actually performing right now and what's possible for the future. And so that can throw people off a little bit, especially in the SaaS world, because now they're having conversations about things that they might not feel as confident about, or they don't necessarily jump into on a regular basis, depending on their financial literacy and their kind of rigor within their organization.
Okay, that makes a lot of sense. And I know you said that, it varies. It can be like a month up to 18 months, but how far in advance would you say, the general like SaaS business should start preparing for a due diligence process?
For sure. I mean, for SaaS companies, cash flow is a massive issue for SaaS companies, as you can imagine, because you're building an asset, and you have to pay to build that asset before you can actually generate any revenue off of it. And then you've got customers who are constantly asking for, I'm sure you hear this all the time at Cinder, more requests and more feature requests. And that all costs a lot of money, right? So what we see with SaaS companies is they tend to look to sell almost too late, where it becomes an urgency for them. So they're running out of runway or out of cash, and they're kind of at this pivot moment where they need to decide, should they go get some more investment or should they just go and sell? And so it's all very quick. And so you want to plan out your exit so that you've got enough time. You don't want to be in a position where you're running out of cash and you're desperate for whatever deal you get on your plate. Any kind of bit of desperation in the air will really turn people off. So you want to make sure that you've got a good long runway so that if the deal isn't something you want to take, you're not going to, go bankrupt. And you want to give yourself at least 3 to 6 months to get prepared and make sure everything's ready to go for that sale. So, these are
Okay.
general terms. It's going to depend from business to business, but essentially you want to give yourself enough time so that you don't feel rushed.
Yeah, that makes a lot of sense. Thank you. And now let's go ahead and let's dive into those top five mistakes. And I believe you have some slides to share with us.
I'll share my slides. Just give everybody a little bit of visual, right? So you're not just looking at our beautiful faces the whole time. Okay, so can you see this slide over here? My top five failures?
Yes, we can.
Okay, perfect. Okay, so we'll jump right into it then. And then feel free to stop me anytime, Melissa, if you have any questions or want to clarify anything along the way here.
Okay, sounds good.
But
And for those joining us live, if you have questions, please feel free to put those in the Q&A at any time. We'll either get to them at the end, or if something is real timely and makes sense, we can always answer it when it comes up too.
certainly. Thank you. Thank you. Okay, so the very first mistake I see all the time is messy books. So, people tend to undervalue the importance of accounting in high growth SaaS companies. They see it as more of a cost than a investment. And so the books are going to stop any deal. So if your data doesn't look clean and reliable, the confidence won't be there, the trust won't be there, and the people will just walk away. So really, the solve for this is you need to have a qualified person in to clean up your books if they are messy or get them caught up or what have you. It's best to have an external person to help out with this. It adds definitely a layer of trust if you have an external party who's completely not biased to the success here, such as like a CPA firm or a bookkeeping firm that makes no difference for them what the results are, but that they are not tied to the business. They're there to just do the work as truthfully as possible and honestly as possible. So you want to make sure that you've got somebody to do that work and make sure that the books are super clean and they're up to date, and that a lot of times with what throws people off during a due diligence is that the buyer starts asking questions. They'll have lots and lots of questions. I had a client where we had like 50 questions a day kind of thing. It was just crazy. And they're going to ask questions that are maybe questions that the business owners never really thought about, or the rest of the team hasn't really thought about. And so having the data segregated nicely can help to answer those questions quickly. So, for instance, if you want to see, if you got different revenue streams, being able to see what that revenue breakdown is by revenue stream, and if there are corresponding cost of goods sold or cost of sales for those revenue streams, having those split out separately as well, so that at the end of the day they could see the gross profit by revenue stream, for instance. That's a common thing. Understanding the labor costs, so having your labor split into cost of goods sold or cost of sales and admin, so that we know, okay, what's the percentage of admin labor versus cost of sales labor. That's really important too. So those are some areas that are generally needed to be segregated, but there could be other areas depending on what's happening in the business. Anything that's going to make it easy for someone to look at your financials and go, okay, I understand what's happening here, and not have it so compact that they can't make sense of it. For example, when you're looking at a compilation, your CPA would put together at the end of the year, your financial statements. They're very compact and small, and they're not giving you month over month numbers at all. In a due diligence, they're going to want to look at that out of the gate to see, is this company worth spending time with? But when you're getting into the due diligence, they're going to want to see what's happening on a month over month basis and see those trends as well. So you need to make sure that everything's in the right periods and it's all reconciled correctly. Everything needs to get reconciled. Your merchant services accounts. I mean, this is why we love Cinder so much. It helps to make those reconciliations beautiful. All those random PayPal accounts, like everything needs to be reconciled so that we don't have weird trailing numbers all over the place. Any of your tax liability accounts, everything just needs to be done properly. And you need to get those month ends done properly. One thing that's often missed and not done well with SaaS is deferred revenue. So if you have quarterly payers, annual payers, that needs to be deferred properly. And that's really important for the seller because that's going to impact the price. Okay. So it's not, you can't do cash basis with software. Okay. And then amortization as well. So, all the normal things we look at a monthly basis need to be considered so that it's as reliable as possible. Okay, on to the next one. So no or poor forecasting. So people tend to think they're just going to look at what's on the table right now, but the buyer wants to get a good, clear idea of where could the company head. They'll have some ideas in their mind on what they want to do with the company and how they'll build new and better value. but they want to hear from the business owner and their team as well about where they're trying to head to and how they're going to achieve that to help make sure that they're validating their ideas as well. So that forecast is really important. And it's often something that's, not considered. They don't put a lot of time into, and they're going to pick it apart quite meticulously. So you need to make sure that, again, if this is something that you're not good at, hire an expert to do this. It's a good time to spend the extra money, so that you've got a good forecast in place. And it can't just be the profit and loss, just the P&L. We need to be able to see how that P&L is going to impact cash at the end of the day, and make sure that you've taken into account any kind of loans or debt payments, and any other kinds of things that can impact the balance sheet. So it needs to be a three-way forecast. We wouldn't do this in Excel. It's way too meticulous. And what'll often happen is you end up reforecasting and reforecasting and reforecasting during that due diligence as things change. And so you need to make it a nimble process for yourself. So use an app. I use Fathom and Sift quite extensively for forecasting. They're both awesome. Use them for different reasons. They're both great apps. And so, having that connected into your accounting software just makes it really easy to do forecasting. And then make sure that your assumptions make sense so that because people are going to ask, where did you come up with that number? Why did you pick that number? And in all my years as working as a financial analyst and as a CFO, I was never able to take someone's financials and add 5% and then that be the budget or the forecast. It's so much more meticulous than that. So you need to be able to paint that picture for people so they can check if it looks valid or not. Does that make sense?
Yeah, that makes sense. Thank you.
Okay, so then number 3 is letting key people know too late. So the awkward thing about a due diligence process and selling your business is that you have to deal with the breakup with your team. And that's one of the hardest things for business owners, they feel that they're letting their team down or they're neglecting them or what have you. And it's just a fact of life. It's something that has to happen. There's a lot of negotiation and who you're going to keep and how long they're going to stay for and what kind of promotions or extra pay or what have you, that the new company can put in place. But ultimately, they're going to find out at some point. Now, a lot of times business owners wait too long to let some really key people in on what's happening. And then they're left, either the business owner up till like 3 o'clock in the morning to try to rectify data issues or find things, or dump a whole bunch of work on somebody last minute. So they're now dealing with the shock of, oh, we're possibly going to sell here and I don't know if I have a job anymore and you want me to do all this extra work. So you can put an NDA in place with any of your team members that you absolutely will need for this process. And it's better to do that sooner than later so that you can plan things out and say, okay, with your person who's responsible for HR, you're going to need all the employee contracts. They need to be up to date, signed, ready to go. Any pay increase documentations, la, 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 la. So get them started on that earlier than later so that it doesn't have to turn into a big drama. It's the same with, your CTO or key people who are responsible for development. You're going to have to have all your technical documentation in place, all your process documents, all that sort of information. They're going to be like opening up the hood and looking at the good, bad, and ugly. So you want to make sure that you're looking as clean as possible, and you're not going to be able to do it yourself. Okay. So just know that the sooner you do this, the better. Like I said, key people are going to be needed to help. So let them know as soon as possible so that they can prepare and do their best job as well. Because nobody wants to feel like they're going to put the sale at risk because they didn't get their part done adequately. Get them to audit the employee files, the time records, customer contracts, everything. Just get it documented. It's okay. You're going to find deficiencies. Everyone's going to freak out. Don't worry about it. It's very common. No company's perfect. Okay. I've never seen a perfect company. So just when you find those deficiencies, figure out how to fix the problem. And if you've done your work and you started early enough, there's time to go, oh, it looks like we didn't get that contract with that client countersigned. Oops. Okay, well, let's send it over to them and get them to actually sign it now. Or that employee had a pay increase and they still haven't signed off on their contract. Oops. Okay, well, let's go deal with that now. You don't want to do that and be like, okay, I got 20 minutes for you to sign this paperwork. Thank you very much. So do it sooner than later. I talked about the technical documentation. So making sure that that's all just like nice and beautiful so that their technical team can just read over it and feel happy. Okay. And that takes a lot of time. And sometimes you might need to hire an external person to come in and document things for you. And that's okay. But you want to give them time to get up and running. Again, at the end of the day, you just want to be as ready as possible because they're gonna look at the most random things you never thought they were ever gonna look at. It's always Murphy's Law that they're gonna, look into the things that are not as organized as they should be, so just prepare for the prepare for the worst. I'm just gonna stop and see if anybody had any questions yet. I've got the
Doesn't look like we've had any audience questions, but please, if you are watching live, feel free to drop those questions in. We'd be happy to get to them. Speaking of, you mentioned that they will look at kind of the most random stuff. Do you have, without obviously telling like the name of the company or anything, any funny stories you can share about a time when something like that's happened?
For sure. Oh gosh, there's so many of them. I'm just trying to remember off the top of my head here. They were just like getting really nitpicky about, equipment that were in an office, like what kind of cameras and like televisions and the sizes and how, everyone getting very, very particular about the fixed assets in an office that we were going to close anyhow, and so it's like, okay, they're probably not worth much right now anyhow, but it just became a big thing. Some of the teams like educational backgrounds. So like somebody got really picky about like where everybody went to school, their transcripts and all that. You're like, okay, people don't ask for transcripts now when you're hiring. So like just simmer down. So they just something will come up and they'll want to dig into things and you never know where it'll be or they're very particular about certain types of things. So the forecasting as well, like understanding why revenue is in one place more than the other and how it got to that point. And, those sorts of things get picked apart quite a lot. But for odd things, it's always weird things you'd never expect. So it happens. And if I think of any more along the way, there's been a lot of funny ones. I just can't think of them at the moment here.
Okay.
But yeah, the office equipment was a bit odd.
Yeah.
Okay, the next one is the no or poor transition or growth plan. So I think I've alluded to this, but they're really going to lean on the business owner and their kind of gut intuition on where they think the company can head from here, and they want to know what the company's been focusing on and where if they continue to run the company, where they would lead it to, because you obviously created a successful company, you've done something well, right? And a lot of times that gut intuition is really good. Otherwise, you wouldn't be where you are. And so they want to understand that, and they want to understand that in probably a deeper way than most buyers or sellers expect. And so you want to think about what that growth potential might look like and document it. So, I had some clients that created like a big long manifesto to explain, okay, if I were continuing to run the company, this is what I'd want to do. This is why, this is the team I would use. Here's what I'd expect to happen from a financial perspective. So you can kind of paint the picture for them so they can understand the true value. It's really helping to sell your company better because it's showing some of that value that they might not have considered. There might be some certifications that you have or some certifications that you're about to get. There could be some regions that you're about to unlock that they hadn't thought of or considered. And there might be some partnerships that you've been working on that would unlock a whole bunch of revenue. And that might not have occurred to them as well. They don't know everything about your business and they never will for years to come. It takes a while to really fully grasp a company. So painting that out for them is really helpful for them to, validate the value and maybe even see that there's more value there than they had originally expected. Um, there's going to be, some changes with the team. There always is in some way, shape, or form, and that's kind of good and bad in many respects. It's probably better if the business owner is making those recommendations on, who to keep and how to keep them and what were, and so I've seen companies do a really good job with their team by making a really solid recommendation on here's the folks that we want to keep. They need pay increases. They've been doing a really good job. Here's some roles and some development plans that we would recommend for them. And these people, they've done a great job, but that work is kind of dwindling down. So we need to get them either into a different role, or maybe there's some roles for you at your company, at the or buyer's company that they could transition into. And so that kind of helps to make it a little bit easier for the team to get taken care of after the fact. Yeah. And make sure all of these things are in your forecast as well. You can't have all these great hopes and dreams and then the numbers tell a completely different story. It all has to be kind of unified, if that makes sense.
Yeah.
Okay, and then lastly, hire the wrong experts. Okay, it can get really stressful, when you're going through these processes because it's probably not something that you do on a regular basis. And so having some experts in the room will help you to make sure that you're making good decisions along the way and not taking a low ball offer or not, giving them too much information about things that they don't need or what have you. You got to protect your company at the end of the day. And so there's some key people that I recommend and I don't recommend. A lot of times people ask me if they need to get evaluation done. Evaluation is only worth the paper that it's on. At the end of the day, a company is worth whatever somebody's willing to pay for it. And so you can go get evaluation done, but it's not going to sway the buyers in any way. They'll come in with a certain number, certain amount of cash that they're willing to part with. You have to trust in yourself. What is your, you know, get out of bed money, as we say it on Flow? Like what is going to get you out of bed to work this deal? What is enough to make you feel like you've got a fair deal here? And if you're playing within the same ballpark, then the valuation is not going to change that. I've seen some acquisitions where they've requested a valuation, then sure, just don't spend a whole lot of money on it because they can get up to $80,000, which is not a good use of your cash right now. They can go as low as 5 to 10. So go for as cheap and cheerful as possible at this point in time. But only do if it's absolutely necessary. A broker, I'd highly recommend. They're like your negotiation BFF. So, it's hard to negotiate from a place of power when you're negotiating for something you've got emotional, tie-in with. So a broker is really good to come in and do the negotiation on your behalf. You don't have to be part of the conversation. They can work out probably a better deal. They've seen lots and lots of deals. They know what's fair and what isn't. They've probably worked in your industry and know what they've been able to do with other companies. So they might even be able to get you a higher valuation or higher payout than you expected. Or they can work out, portions of the deal in a certain way so that it works out better for you in the long run. So they're worth the cash. They're expensive, but they're worth the cash. And you want to make sure you hire a good one. So, interview lots of people, find someone that you get along with and that you feel good with and you trust because they're going to either make or break your deal at the end of the day. A lawyer with expertise in M&A is a must. So your cousin who's a family law lawyer is not who you're going to bring on this deal. Okay. Love the cousins, not for this deal. So you need to find somebody who's got really good M&A experience. They're going to be probably a bit more expensive per hour, but they've done it before. So they're going to do it a lot faster. And they're going to be able to have your back and make sure that any deal that's coming across your and their plate is as fair as possible for you. So even if all the agreements have been reviewed by your buyer's lawyers, you still want to have somebody in your corner checking the deal to make sure that it makes sense on your end. Okay, it's well worth the money there. You might need a tax lawyer as well. We've had a lot of tax lawyers involved in our acquisitions because sometimes we get into situations where we need to do some restructuring. So, if there's any restructuring that might need to happen in the company, you want to do that as soon as possible so that you're not going through a restructuring and an acquisition at the same time. That's like double whammy fun. But it happens. And so that's just something that an accountant and a lawyer are not the best at doing, but a tax lawyer is. And so you need somebody who's got those both brains who deal with restructuring all the time. And again, they can figure something out really quickly, get the paperwork done, and just close it up quickly. Again, it's worth the expense for potentially saving you a bunch of personal tax at the end of the day. And then finally, yes, get a financial expert on your side. Okay, so don't if you have an internal bookkeeper doing all the work, this is going to be well above their pay grade. So even hiring somebody to come in and help out, a CFO, fractional CFO, or CPA, or somebody to come and help you just for a short period of time will also you're going to make up for it in the selling price at the end of the day when you look good. Okay, so those are I think that was it. Yeah, that was my 5 of mistakes to avoid, and hopefully those are helpful for everyone on how to set yourself up for success here.
Yeah, I'd love to know in the chat if you wouldn't mind sharing anyone who's comfortable. Were any of those a surprise to you? Are there any that you would love to have a little bit more clarification on? Let us know in the chat and we'll address that. While we're waiting for that, I'd love to know like which of those of the 5 would you say is the one that you see happening the most often?
The financials. Yeah, it's usually the financials that are not up to scratch. And so it's really hard to get confidence in the company numbers when there's glaring errors. Yeah.
That makes sense. Would you say that's also the mistake that causes the most damage, or is there another one that you would pick for that?
I would say for sure. Yeah, it causes the most damage for sure. Um, because if they start to think, oh, these numbers aren't trustworthy, or it looks like there's some area glaring mistakes here. Well, maybe there's some glaring mistakes in other places too. They'll start to discount their selling price essentially because they're going to leave more room for risk, or they might say defer some of the payments a little bit longer or a higher amount of it until they can feel confident that these numbers are good. And so,
Okay.
and also we've seen due diligences basically just fall apart because the financials weren't good enough. So we were brought in mid due diligence because they couldn't get anywhere. The numbers were that bad. And so they kind of started off on the wrong foot. They had to wait for us to quickly get everything up to, and of course they want it done like in 2 days, which is impossible. So it delays the whole thing. It's like if you're in a relationship and you're waiting for the other person to propose to you for a really, really long time. By the time it happens, it's like, oh, the magic's not quite there. So you want to make sure we keep these relationships nice and short so that the magic is there as long as possible. And any kind of delays where someone, people have to jump in and fix things, it doesn't keep the sparks alive.
Yep. No, that makes a lot of sense. So let's say if somebody, on this call or watching later, they've identified they are making one of these mistakes, let's say, how can they recover quickly? I know we talked a little about the financials, but let's just say like with each of them, like what's kind of like a quick fix? I know that probably can't be fixed quickly, but how do they start making headway on that?
Yeah, I think you just need to hire an expert. Like if you're short for time, just get somebody in to help you out. So, any broker or lawyer or accountant that does M&A will know people that can come in and help out really quickly. The HR side is often neglected, and so we're going to need to see those contracts. If there's no contracts in place, we're going to need someone to come in and just get those all done up quickly and get everyone signed and explain to the team why all of a sudden we're all freaking out about employee contracts that weren't signed. So there's people that are really good at navigating those sort of situations. So getting some help will probably help to make it smoother. You got to where you got to without paying people to do those things. So now's the time to pay for it. Yeah.
Yeah, that makes
Yeah.
sense. Definitely. So let's jump a little bit into the financials and building trust. So what financial documents and data must be prepared to ensure a smooth due diligence process?
For sure. So, no surprise, those financial statements are really important. What we've done as well in the past is we've given the sellers, or sorry, the buyers, access to the accounting software as well, so they could go in and they could look at things as they wanted to, and that helped to build the trust because we're like, here's our underwear drawer, go take a look, and that we've got nothing to hide, so that can help to make it a little bit faster if you're trying to close quicker, so they can go pull the reports they want and dig into things, and then we meet with them on a regular basis, their finance team and our finance team, to go through questions. And that really helped to just kind of speed things along. Now, not everyone's going to feel that comfortable, but certainly being able to get the financial statements to them and dig into numbers and answer questions really quickly will help. You need a forecast for sure. So having a reasonable forecast, 3 years is probably enough. I wouldn't go to 5 to 10 years. That's la la land as far as everyone's concerned. But just having the rest of this year forecasted plus another 2 will give them a clear idea of where they're heading. And like I said, make sure that you're including all of the recommendations and other kinds of things that you would hope to do or you think that they should do, so that it's all kind of tying nicely. All the labor data, the salary information, contracts, customer contracts, and employee contracts, all that is necessary. At the end of the day, for SaaS, it'd be, sometimes you have contracts in place. Sometimes you would have, annual subscribers and quarterly subscribers. So just having information about those counts of people. So how many people do we have currently that are monthly with only a month notice, or quarterly, kind of locked in a bit more, or annual? and understanding the LTV, some of the metrics tied to those folks to understand like what's your churn and what's the likelihood that these people are all going to stick around. They're going to do their own forecasting based on their thoughts there, but they're going to want to see where theirs and yours kind of come together at the end of the day. So there's
Okay.
some major things to pull together. Yeah.
It makes a lot of sense. And I like what you said about you share kind of the financial software to build trust with the stakeholders. Are there any other ways that you can suggest for SaaS businesses to build that trust during this process?
I mean, getting them access to key people to meet with them, um, and uh, and customers, is all very helpful as well, so that they can kind of hear from other people, what their thoughts are, right? So just being able to validate, hey, this has been, really helpful company for us, and this is how we use it, and la la la, will help to validate some of the statements that the owners would be making. So I think it's a lot of trust building that needs to happen. So, just even meeting with them on a regular basis, like it's very easy to just have, people send requests back and forth over email, but we always make a point of actually getting on a call every week as much as possible, just so you can get that FaceTime and help to build the trust, have a little preamble, giggle at the start and some, what I mean, just build a bit of relationship and, and give them, make them feel comfortable asking the questions that are coming up for them. Yeah.
Yeah, that makes a lot of sense. Are there any common red flags that businesses should watch out for that maybe would suggest they're heading towards one of these top five mistakes?
Yeah. So, I mean, there's a lot of, you got to make sure that you're excited about the potential buyer. So, I mean, there's bad buyers out there. There are people who will waste your time and not have the money, will try to give you a really bad deal, or, looking to do something that you're not super excited about, so there's some buyers that will try to like push the deals through really quickly and not want to spend any money along the way. So they might be super cheap and then they don't want to have a lawyer. They don't want to pay for lawyer fees. Maybe they're not willing to share any information about um, their company and what their plans are. That would definitely be a red flag. You're not expecting them to necessarily give you their financials, because that's not part of the program here. But you should have some kind of sense of like, what is their expertise and what do they do and what are their plans. And if they're really squirrely about it, then that would come. I don't know. That'd be a red flag for me. People who are really pushy and aggressive, I would stay away from them as well. You have to remember, like, you're going to be kind of stuck in this deal once the deal's closed for probably another 12 months. Like generally they want the owner to stick around for, 12 to 18 months. I've never seen anybody stick less than 18 months. But and usually the seller wants to get out of there and the buyer wants them there, and so you want to make sure you don't have, payout tied to performance while you're still sticking around after the fact, because they're going to control things that you can't control anymore. So the performance of the company is out of your hands. And that's a common thing that people try to do is they'll say, oh, okay, well, we'll pay you this much now, and then we'll pay you based on performance over the next little while. Well, no, 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 no. The acquisition valuation right now is based on what you've built already. And so stay away from anything that's tied to future performance because you can't control it. You're not running the company anymore. So it's kind of not fair. And also, you're going to lose your day-to-day drive because you're not in charge anymore. And sometimes you don't have the power to do the things you need to do. And so you want to be careful about those payouts after the fact. That would be a bit of a red flag. And if people are getting really pushy and aggressive and threatening to leave at the table, just let them go because they're probably not worth your time. Yeah, there'll be another person out there. And that's why, when I go back to, when to get started on this, you want to leave yourself some time in case that first attempt doesn't go through, because not all deals go through. I think, I don't know what the stats are, but I would say it's probably about 50% of them go through as planned. So yeah, so you got to plan for maybe two kicks at the can.
Okay, that's good to know. So yeah, if anybody here has gone through a situation where it has not gone through, just know you're in good company. If that's the case, about half aren't going through. So Just keep that in mind. So the things that you just talked about really kind of spoke to like transparency or having, or maybe even a lack of it, how that will impact the success of a process. Are there any other things that you can think of that would, kind of impact that, how transparent someone should be or shouldn't be in this process?
Yeah. So, I mean, you want to be careful. You want to give them enough information so they're feeling confident, but you also don't want to give them all your trade secrets in case they turn around, steal them, and go build a, improve their business with it. So it just depends on who you're in conversation with. If you're in somebody, like if you're talking to a competitor that's looking to buy you out, then you need to be very careful. Because if there's nothing legally binding there that forces them to buy you, then they could steal your trade secrets, and then what are you going to do about that? I mean, you could sue them, but I mean, that's not probably what you want to be doing when you're trying to sell your business. Um, so, you want to be transparent enough that you're building trust and confidence, but not putting your company at risk, if that makes sense. Not sure if I answered that question effectively
Yeah,
there.
no, that makes a lot of sense. So what would you say are some communication strategies that are the most effective when you're dealing with, potential acquirers?
Hmm. So like I said, we try to have that FaceTime at least once a week just to kind of keep things moving and build the trust. Be super prepared so that you're not delaying the process and it's not taking a whole bunch of time to get back to them on their requests. You want to be able to turn things around ideally within 24 hours if possible, So if you've got everything kind of done already, then it's not that big of a deal to pull it. We'll generally, usually we'll have a data room of some kind, and we'll generally put a bunch of information in there that they maybe didn't even request, but that might be helpful for them anyhow, because they'll probably need it at some point. So just kind of preemptively giving them information so they can go and do it in their own time will reduce the back and forth. Just making sure everything's really organized, like naming conventions for documents is making, something that's so basic, but like, having this, some structure to the folders and the naming conventions. It's all part of that communication piece. So we're not wasting time going, where is it? I can't find it. We're not, we have another call. I can't find this document. No, 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 no. Like that's not my bag. So it's not what I love to do during the day. So just making sure it's all nice and organized and clearly labeled, and then over communicating to them. I just gave you all of these documents, and here's some assumptions you might need to know about some of these documents. And if you have any questions, let me know. Just being over communicative so that it's clear for them, because you don't know who on their end is consuming this information at the end of the day. So you might be speaking with their business owner and their lawyer, or their broker if it's the other way around, but they might be passing it over to, their CPA firm, or an external lawyer, or a whole finance team, or blah, blah, blah. And so you want to make sure that, any key bits of information get passed along. So, because they're obviously just going to like throw things at them and not explain it fully because everyone's busy. So anything you can do to kind of make the information easy for everybody to access and to consume will just speed up the process for you, so you're not repeating the same thing over and over again.
Yep, makes good sense. Great. I do have a few more questions to ask you, but I just wanted to remind everybody here that's live that you have an opportunity here to ask questions. And I also want to let you know, if you use that Q&A box down in the bottom of your Zoom screen, you can actually ask your question anonymously. So if you prefer to stay anonymous, you can do that. Yeah, so please get those questions in. We're heading up towards that time for Q&A. But while we're waiting for those questions, what would you say is your number one piece of advice for SaaS founders to navigate due diligence successfully?
Oh, cool. So be prepared. I'm kind of repeating myself here a bit, but you want to start that process early and make sure you're not putting all your eggs in one basket. So if you've got, you've got to manage your time here. So if you're, banking on a very quick acquisition so that you can, because you're running into some tight cash flow problems, that's not going to work very well for you, right? So make sure you're doing this well in advance. You've got some time banked there for, potential deal falling through and another one picking up. And and then you're going to be in a good position. You've got enough time to get yourself organized and get all your data together. like I said, a lot of times SaaS companies are under the impression that everyone's just going to look at the code and meet with their team. And it's so much more than that they're buying than just the application. Um, and so and there's a lot of liability. A lot of people don't understand this, but depending on if the sale is an asset sale or a share sale, if it's a share purchase, then any kind of issues that the companies accumulate, any potential legal issues or debts become the buyer's responsibility. So they need to make sure that they are not taking on risk that they're not willing to take on. So, that they need that time. So prep for that. And also the one of the main things too that a lot of business owners forget is that you getting involved in a due diligence is going to take a heck of a lot of time away from you running the business. And so, one of the key things we haven't talked about yet is really just setting your team up for success. Now, everybody's going to be able to know what's going on, but you're going to want to be able to pass some of your responsibilities over to somebody else so that they can jump in and run things for you while you're busy doing all the secret stuff that nobody knows is going on, and and stressed and asking for weird things and not able to explain why you're asking for them. So having some key people step in and take over some of your responsibilities. Again, another reason why you want to talk to key people earlier on about what's going on so they can jump in and help will make it easy for you because you're kind of otherwise burning the candle at both ends, trying to like get through this due diligence that takes way more time than anybody ever expects, and trying to run your business at the same time and push growth and push the sales as much as possible. And that's not easy for one person to do. So I had one broker as a really wise advice to the business owner and said, this is a marathon, it's not a sprint. Okay, so we need to be able to get ourselves into a good pace, but we can't have you crash on us. And so you need to make sure that you've got your team there to support so that you can focus on the due diligence. And like I said, any way you can get the rest of the team to help out with the due diligence is going to make your life a lot easier too.
Okay, great. Thank you. So let's say somebody on this call is feeling like, okay, they are ready to start this process with due diligence. What are like a few questions that you would recommend they ask themselves before they embark on this?
Cool. Um, are they ready to sell? Like, are they prepared and ready to sell? What types of people or what type of companies do they want to sell to? It's very common for someone to go to a broker who can then send out a prospectus, sorry, to potential companies. And through that process, you can actually really be choosy about the people that you want to sell to. So you have say in this, right? You don't need to wait for someone to come at you. And do I have the time and cash to do this right now? Because there's other ways to, if you have a cash burn issue or a cash runway issue, there's other ways to deal with a cash issue than to try to do a quick sell. And so, is it the right time?
Okay, perfect. So how can attendees access more resources or support to prepare for this due diligence process?
For sure. So, well, we do a lot of them at Entreflow, so feel free to reach out to us. If people have any questions, I'm happy to answer any questions people have. And otherwise, I think, finding a good broker is probably the first step because they'll help navigate through the process. They do this all day long. So they'll be able to help prepare the company, so that it looks good, and that it's ready to go. So, just getting the interviewing some brokers and finding one that they can connect well with is probably a good first step.
Okay, awesome. And can you let us know maybe in the chat, as well as just you could say too, what's the best way for people to get in touch with you? I know we're going to have a lot of people watching the replay and they're going to want to reach out.
Yeah.
Let
For
us
sure.
know.
Yeah, you can reach out to me on LinkedIn. Our company is Entreflow Consulting Group, so you can go to our website as well and chat with us there. And I'm pretty easy to find on LinkedIn with the name Helena Patience because I'm the only one. So just feel free to reach out and connect with me and let me know any questions that you have.
Awesome. Well, this is our last call for live questions. It looks like you've answered every question people came to the webinar with the presentation, so that's great. But we'll give it just a minute here in case somebody is typing. There's a little bit of a delay sometimes on the chat, so I just want to make sure we don't close out too early. But thank you so much for being here today. This was really interesting and informative, and I'm sure a lot of people that are watching live and that will watch the replay are going to be really glad to see this. Thank you.
Awesome. Awesome. Well, thank you so much for having me. It was great to be here. It's not something I talk a lot about, but I do a lot. So it's nice to share, and hopefully it was really helpful for everyone, and you got some good tidbits on things to take away to make your life easier.
Awesome. Well, I think that concludes everything for today. Thank you so much, everyone, for joining us, and please stay tuned for future Cinder webinars. We'll see you next time. Thanks.
Good.
Bye.